This is Cece. Welcome to the Orbit. It is Friday, March 3rd. We've got stocks higher today. We had a 1-2 punch. Last night we had Apple earnings, which took the market higher after hours last night. That was followed up by the jobs report this morning, which was softer than expected, but still positive. And that was sort of the Goldilocks signal that the market was looking for, especially given what Fed Chair Powell had said earlier in the week. So now a lot of people are saying, well, we're clearly not raising rates and we might be lowering rates towards the end of the year. And that is once again back on the table. So stocks are taking all of that positively. We are up about 1.1% on the day in SPX. That is just a little bit more than what options were pricing. Options volatility was very high this week, short duration option volatility. This is an expiration Friday. It is not a big monthly expiration, but it is a Friday nonetheless. And so therefore, we were going to be looking as traders to see what is going on the rest of the day. Do these gains hold? Do we start to see that trend that we've been in for the last couple of weeks, that trend of volatility, that trend of rallies being sort of viciously sold, sometimes intraday? Do we see an end to that? And you can see we are right there at the top of this level in the chart where we are hovering around those recent highs of the last 2 weeks. Does this hold? Do we pin somewhere in here in this 5,100 to 5,125 range? Or do we dip back below today? Does the market find sellers? Now, as far as trading for 0 DTE just today, let's go in and check those current levels. Right now, it is pretty tight. We are down to about under a 0.4% expected move. That 0 DTE IV is about 22. So going out a little further and getting down to that sort of 4-to-1 risk, we get down at least below that 5,100 level of the SPX, and we have that short call up at the 5,150 level. This would be assuming that we would finish somewhere sideways from here, or that if we did pull back a little bit, 5,100 would be a little bit of support. And if we went higher, you would be inside, you would find resistance at the day's highs, which are short of that 5,150 short strike level. Now, going back to the overall vol backdrop, I'm mentioning that is 22 IV for the rest of the day. That is much lower than what we've seen over the last 2 weeks. We've seen some 0 DTE IV above 40 this week, particularly on the Fed day. We saw it up over 30 going into today and the non-farm payrolls number. And what is happening at the same time is the VIX over the last couple of weeks has actually been declining during this. And what's going on is traders knew that going into this week, we had mega cap tech company earnings spread out over this week. The last week we had Meta, for instance, last week. We had Apple and Amazon this week. And then on top of that, with an FOMC announcement and the jobs number, this was a really busy week with headlines and known headlines ahead of time that were coming. And so options traders were conflating near-term volatility in the 1 to 2 to 3 to 4 DTE time period, but looking out to next week, options premiums had already started to decline. We saw the VIX, which got up to over 20 a week and a half ago, start to decline into this week. And that's because the VIX is looking out more on like a 30-day window. So 0 TPE vol and 1 and 2 and 3 and short duration vols were sky high this week as we were going every day. It was like a new economic data or a new mega cap earnings. But the VIX was already getting ahead of the fact that this week would be the end of a lot of those headlines for some time. Now, obviously, earnings continues and earnings season will continue, but next week doesn't have a lot of big economic data. We've got some Fed speak, we've got things like that, but this week was the big week on the economic data front. So what does that mean for a market backdrop and options trading is vols have already started to come in. If we look out next week, we can see some of the lowest IV levels that we've seen in quite some time. Here we've got like a 10 and 11, 12. These were all 15, 16 just a couple of days ago. So the market has reacted positively and stocks are higher, but also vol has gotten quickly crushed. And what that can do is that can send the backdrop of the market, that can kind of change on a dime. When vols are sky high, 0 DTE and short duration vols are sky high, within a week, you see a lot of this day-to-day movement. This Fed day, a perfect example, as we skyrocketed after the announcement, and then towards the end of Powell's press conference, we sold off pretty violently into the close. That's the sign of a market with a lot of short gamma in it, short duration, a lot of traders buying puts, buying calls, day trading, things like that. But at the same time as that was happening, demand further out on the calendar was starting to decline. And you've seen the VIX go from basically the high teens now to about 14. And the gamma backdrop then starts to change. You have a lower volatility backdrop. And that means we may start to see some smaller intraday moves, less gaps from day to day pre-market. You might not see those big gaps higher and those big gaps lower. Now that is unconfirmed and it's very dependent on today's rally holding. If today's rally holds and then Monday morning you don't see much of a gap pre-market and that sort of continues next week, and next week's a very quiet week, what happens is that's a lot of options traders and a lot of equity traders taking some volatility out of the market, options traders selling options that maybe they were long, and the market starts to get loaded with gamma, and you start to see rallies find sellers very quickly. You start to see sell-offs find buyers very quickly, and you sort of play a little bit of ping pong. Perhaps that turns into a grind higher back towards these highs. That's sort of the perfect backdrop for a grind higher. Now, if that changed on a dime, if we got some sort of macro scare back into the market, if treasury yields started going back higher, treasury yields have been going lower the last 2 weeks. If you look at the 2-year yield, you'll see that. And TLT looks to have found at least a temporary bottom. That's the kind of things we're looking for. Does TLT get back above 90 and start going higher? That's the type of thing that the market would potentially turn into a much quieter market, perhaps a bullish backdrop, perhaps a slow grind higher backdrop. So from a trading perspective, from selling options, it might be a good period of realized vol. However, you have to be aware that you're selling much lower levels of implied vol, and therefore you have to be careful about your levels. You have to be very deliberate to see how Monday morning reacts. Is there any sort of hangover on the market? Do we make any sort of gap higher or lower next week? But if we start to see small pre-market moves, it will be a sign that the gamma backdrop has indeed shifted from this week. One final point on this fact that the volatility has come in, there weren't many good opportunities for directional plays in the options market over the last couple of weeks. When we saw that VIX up near 20, you would have been spending a lot of money for premium, for hedges, for positioning to the upside, for us to take out those highs again. But what's happened with this compression in vol and with that VIX that's now below 14 is you can look out here and you can see these vols are back into the low teens. And so what that means is you look at this high right here, and if you were positioning for us to go back to those highs, the options market is giving that really out until the end of May or June. That's the kind of time period that kind of 3% move, that's a 3% expected move we're looking at out at June 7th. The same thing is true for that downside. If you missed the chance, you're still worried, and you're looking for hedges even out really far in the year, it's the expected move back to those lows is now pushed out back to June 7th. If you go on a 1-year chart, there's really out until the fall, we are back to, some pretty reasonable vol levels, 13. If things got really slow, you could see these down near 12. Things don't change really until you get out to October and November, and that is obviously in December. You see this, that's obviously the election out there. So there is a VIX curve out to the fall, but for the summer and for the next month or two in particular, vols have compressed, and there are opportunities for calls, puts, call spreads, put spreads that get you into positioning for 5 to 10% moves, perhaps looking out on the calendar, that aren't costing you a lot of premium like they would have a couple of weeks ago when the VIX was at 20 and some of those vols out there were closer to 17 or 16.